Hey, welcome to the Guaranteed Retirement Guy Show. So, today we're going to be talking about the best single premium immediate annuity. So, what are these? So, you have two different types of paying into these annuities or funding these annuities. One is, you can set up an annuity inside of a 401k or a 401a or an IRA, and you can just start putting money in, 500 bucks, 600,000, depending on what your limits are in that particular account. And you can fund that annuity over, 10, 20, 30 years. So this is pretty popular with a lot of school districts, especially people who have their money with TIAA. TIAA actually manages around 1 trillion in assets for teachers around the nation. So, and it's really just a giant insurance company, and most of the money that are in people's accounts are typically in some type of annuity contract. But most people that I work with, they're either leaving a job, maybe transferring from one job to another one, and they're looking to transfer their old 401k into, something else that would protect their money and also give them some guarantees later on. So that's where single premium immediate annuities come into play. And if it's an immediate annuity, then of course that person is retiring like maybe next year, or maybe they're retiring next month. And so they're looking to put a lump sum of money into an annuity, and they want an immediate payout. I would say a near immediate payout would be maybe deferred for 1 year. So it just really depends on what you're looking for. There are some annuities that are better than others for immediate payouts. And so what I do is I will go through a list of companies. Whenever people call me and they want to go through, maybe they're retiring in a month or two and they want to start turning on income and they want to see which annuity will pay them the most, then I'll look at typically I'll look at the highest rated insurance companies. I mean, there are some B rated, but I do like to sell from the A rated companies if possible. They're safer. They have more reserves, and you can get pretty much anything you want that you could get from a B rated carrier. So, all right. So I'm just looking at a list here right now, and there's different requirements. Okay, a lot of them have minimums that are around 20,000, like AIG. Their minimum is 20,000. Their maximum is $1 million. Their maximum age for a qualified account is 71. Maximum age for a non-qualified account is 90. And then you've got Athene. Their minimum is $10,000. Maximum is $1 million. And then max age for both qualified and non-qualified accounts are 90 years old. So they do vary a little bit for those. Let's see, just looking at a few others here. So here's another one. So you've got American Equity. American Equity, again, same type of limits, like $10,000 minimum, $1 million maximum. Now, keep in mind, just because it has $1 million maximum does not mean you can't put more. So I had a partner, he had a client that brought in around $5 million. So you just have to get special permission for it. So what the company does is they'll look at your finances, and they'll make sure that you have plenty of money diversified into either, savings, CDs, bonds, other mutual funds, other stock accounts. They just want to make sure that not all of your money is going into an annuity, right? So they want to make sure you have other funds. And so this guy, I think, had like $15 million. So $5 million into an annuity was only 1/3 of his assets. He was fine. So I'm just looking here to see if there's any others. Yes. So Nationwide is one company where you can put $10,000 minimum, and they actually have a set maximum of $3 million, which I'm sure they would probably raise depending on the type of client. And the maximum age for funding those for both a non-qualified and a qualified account is 95 years old. So just see if there's any more here that I can show you. Let's see. Integrity Life Insurance Company, $10,000 minimum and $2 million is the maximum. 71 years old is the minimum for a qualified account, and then a non-qualified account. The maximum would be 83 years old. So it really just depends. It depends on what you're looking for. It depends on if you need income now, if you need income in a year, 2 years. It can drastically change the type of income that you'll get, depending on when you want to turn on that income. So most of the time, people will drop a lump sum into an annuity, and that's called the accumulation period. And of course, the payout or the lifetime income, or another way of saying it would be annuitization period, is when you turn on the income or you activate the income rider. And when you do that, you have that guaranteed lifetime income, whatever it is, depending on what age you are and when you funded it. And maybe if you had a roll-up rate that allowed it to grow and give you higher income later on, once you turn that on, it's set, and it's set for life. And if for some reason you want to turn it off and you want to take money out, you could do that too. Yeah, it's definitely flexible. But typically, when you set up these annuities, you set them up to last you for the rest of your life. And so at this point, if you were to transfer a lump sum, let's say $500,000 into a single premium immediate annuity, it would pay out different rates depending on if you are married or single. And let me just show that to you real quick, just so you can kind of have an idea. So I'm going to scroll my bar down to 0 years. So we want this income immediately. So it's going to come out next month. And I'm going to base it off of $500,000. I'm 65 years old, and I'm going to put this at A- or higher for the rating for the company. Okay. All right. So this is telling me for $500,000 right now, if I turn on income right now, like next month, it's going to give me $36,875 the rest of my life. Okay. And that's from North American. The next one down is AIG, and they'll pay $35,250 for the rest of my life. Now, let's say I'm married, because I am married. So we'll just go in here and we'll say joint payout. And my spouse, she's 4 years younger than me. So I'll put age 61. And she's a female, so the insurance company knows this, and they know that she's probably going to live longer than me. So they're on the hook for a lot longer income payments because of her. So that does change the income level. Now, AIG is above North American, and AIG is paying out $29,750 the rest of our lives. But I know my wife's going to live longer. She's 61 years old, and just because we're in our 60s and we're married, means that we have a high likelihood of living into our 90s. So let's say she lives 30 years. Okay. She lives 30 years, only lives to 91, and she takes out $29,750. She's going to take out $892,500. But let's say she lives 35 years. And of course, I'm assuming that she'll outlive me. 35 times $29,750. She's going to take out $1 million, a little over $1 million. So she could do that. But let's say she is older than me. Let's say she's 68 and I'm 65. I have a lot of clients whose spouses are older. Well, that changes it again. Now all of a sudden it's back up to $32,750 from AIG, and then $31,375 from North American. Let's see. Alliance pays $30,000 even, and so on. So, and these are immediate annuities. You put a lump sum of cash in there, and it starts paying you next month. Okay. So if I get paid, my wife's just a few years older than me. Now all of a sudden, let's say we live 35 years. 35 times 32,750 equals 1.146. So now we're getting close to $1.2 million in guaranteed income. So lots of things to consider. And a single premium immediate annuity might not be what you need, but then again, maybe it is. Maybe if you are looking to retire right now and you need income right now, this would be perfect. But if you want to wait 1 year, maybe you're a year from retirement. It changes the numbers. So it changes the numbers drastically. Even 1 year, I didn't change anything. I'm still 65. My wife's 68. It changes it from $32,700 to $36,700 in literally 1 year. So it gives you an extra $4,000 a year just by waiting 1 year. So anyway, something to think about. Typically what I like when people are buying annuities for retirement, especially when they're doing a single premium, You might want to make one of them immediate. So one of them might be a SPIA, right? A single premium immediate annuity. So that will turn on income right now, next month. Another one, I might wait 2, 3, 4 years. So what that's called is a laddering strategy. And what they're doing is they might buy, let's say, 3 annuities at the same time, but they'll turn on the income at different points. So the first one, they might turn on income immediately. The second one, they might turn on income in maybe 5 years. The third one, they might wait 10 years to turn it on. And so if I did that, we already know that my income's 32,000 from $500,000. Let's say let's say I put another one in for $500,000 and I turn that income on in 5 years. So if I did that, I'm getting 51,895. So roughly 52,000 on top of my 32. Now I'm making 84,000. But then I also put another annuity in. So I know these are bigger numbers. We're talking about 1.5 million in investment into 3 different annuities, so $500,000 each. But if I were to do that and I turn on income right now, then in 5 years, and then in 10 years, the third annuity would actually pay me $79,000 a year. So we're talking, 79,000 plus 80. I mean, we're over $150,000 just in 10 years of guaranteed income. So you're looking at millions of dollars, $3 or $4 million at least in guaranteed income. So it's just another way of looking at your money, protecting it, and making sure you're set up for success, making sure you're set up for as much income as you possibly can get during your retirement years. And so a lot of times it makes sense to either turn on an immediate annuity from a single premium right then. And then sometimes it makes sense to maybe wait 2 or 3 years to turn on the income for that annuity, or perhaps fund a second annuity that will give you more income, help you fight inflation, and be able to just give you more income, more money to do the things that you want to do. So if you want me to look at this for you, I'm happy to. Just give me a call or email me, and we'll set up a Zoom call typically, and I'll share my screen, and we'll plug in some numbers. We'll look at, see if you're married, we'll plug that in. We'll put in the ages, we'll put in some values, whatever you think that you might invest, and we can play with the numbers and see what they look like. I am an income planning specialist, so I like to look at all income sources. So we'll look at your Social Security, we'll look at your pensions, any other types of investments that are paying you dividends or income. We'll plug that in. And then if there's an income gap, we'll solve it with an annuity. And of course, that's guaranteed for life. And so I like guarantees. I like risks too, but I also like guarantees. And it's a good idea to have really a diversification of some of your assets and risk, and some of it in some guarantees, so that at least you can sleep well at night. So if you do lose everything in your risky accounts, at least your income is covered. And having a single premium immediate annuity, or just a regular single premium fixed annuity that is deferred for a couple of years, both will do the job for you. So thanks for watching. Look forward to chatting with you, and we'll see you next time.